Okay, hello everybody and welcome to this webinar about investment appraisals. So I will actually spend up to 2 hours in this webinar, so it's more like a live training. So we will be doing a full case step by step and comparing different scenarios. I will just start with a very short introduction to our company and then we will get right on to the case. Let's see. Yep. So some words about Data Partner. Yes, so we have been in business for 33 years. We focus on a narrow segment, so it's software for capital budgeting, financial modeling, and valuation. When it comes to software for capital budgeting, we are market leader here in near markets. And we are located in Porvoo, east of Helsinki, with a staff of 10 persons, and we have a subsidiary in Sweden. And we have some 35 business partners in different countries who locally support, train, and sell. All in all, we have sold this software to some 1,750 customers in 56 countries. And we really focus on this one product now, Invest for Excel. And of course, we offer training and consulting services around it. We have quite amazing references worldwide, like Daimler AG, Mercedes-Benz, who uses worldwide this software for their investment appraisals. A lot of consulting engineering companies, oil companies, electric utilities are the biggest customer segment of ours. We have metal industry, forest and paper, food and beverage, and we have for most industries customers. The case today is a manufacturing case. We will make 3 calculations. We will model 3 competing alternatives. We will make a calculation for a new production line to increase capacity of production. And the alternative is to invest in an automated production line. And the third option is to outsource production. So we will model all these 3 cases using Invest for Excel. I will start from scratch and make the first case, and then I will base the other cases on the first case. Then we compare the profitability of these different alternatives side by side, and so we know which is the best alternative, and we can also say why it is the best alternative. And we will also make different sensitivity analyses on risk of the project. Now, as I will be working for almost 2 hours with these cases, and so it will be a lot of numbers and a long time going on, and maybe you are busy and can't stay until the end, and it's of course difficult to remember also. So don't worry, I will send to you this presentation. I will send to you the cases that we solved today, or I solve, so you will get them in email, and also you will get tomorrow a link to this video, so you can even rewatch it if you like. Okay, let's go straight into the cases. So I will just briefly show here the numbers of the case, but then we don't need to look at it in detail, because I will go then and start to create the case, and we can go back to one page at a time. But basically, it's a investment in a production line that can be used for 10 years, and we reserve 6 months for the investment phase to build the production line, and we have a required rate of return of 10% after tax, and we make a nominal calculation, so we include inflation, and we also include tax. And then we have I have a list here of different investments to be made in machines and buildings, and then there's a maintenance investment after 7 years, which we will also include and model. And the investment will be put according to payment schedule, so we get more accurate result that way. And then we have the income, which is really simply modeled. It's the number of produced tons multiplied with price per ton. And the production line has a specific capacity, but we will not use the full capacity, but we will start with a lower utilization rate and increase over time. Then we have variable production costs for raw material and energy, and we also had the freight cost, which is variable. Fixed costs are then personnel, maintenance costs, and other fixed costs. And then we will also take into account working capital, that we don't get paid immediately, so we have some sales receivables, we need to have some inventories of the end product, and we have some term of payment to suppliers for raw materials and energy and maintenance, other fixed costs. So I will come back to all these details later. But once we have modeled the case, we can look at profitability with the different indicators. And then I think we will make the sensitivity analysis on this case number 1, A1, new production line, and then we will look at the other alternatives, which are then specified here later. There is the automated production line numbers for that one, and then the numbers for the outsourced production. So that's basically the case. So I will now switch from PowerPoint to Invest for Excel. And so this is the starter screen of program, and here you also see the different parts within the program. So let me just give you a short introduction to that. First of all, there is the menu on the top, and the menu has now replaced Excel menu. So you can get to different parts of Invest for Excel by pressing these buttons. But you can also switch to Excel menu. You need Excel menus every now and then when you want to use Excel functions. And if you prefer, you can have Excel menu visible all the time, because also then you can use Invest for Excel functions here at the right in this Invest menu. You can access most of Invest for Excel functions right here. Or then you can do as like I do, switch back and forth between the menus. Then you see also the buttons where you can access different parts. So typically when you make a calculation, you start with some basic values, basic assumptions for your calculation, like time and periodization and discount rate and taxes. Then there's the contact information for your own contact information and some information about the case. Then you continue here to investment table to specify the capital expenditures and depreciation methods. Then you continue to income statement where you model the case, the business, the project or the business is modeled in the income statement. So you name income rows, you name cost rows, and then you create a hierarchy on how the income is calculated and how the costs are calculated. So you can use sub rows in 3 levels. Take as many rows as you need to model the case. And then you can hide the sub rows, and then you have a income statement showing profitability per period. And as you remember, the periodization is flexible, so you can have monthly or annually or anything in between, quarterly, half year, or whatever you prefer. And it can also vary within the calculation. Then you continue to working capital, where you see how much money is tied up in this project or business. Accounts receivable, inventories, accounts payable, so you calculate the net working capital, which impacts cash flow and has an impact on profitability also. So next is already a report. It's a cash flow statement that gives a good overview of the cash flows of the project, and also shows the need for financing. Then you continue to next report is the balance sheet. It's automatically based on the input values here when it's a new project, but if it's something existing, you can have some opening balance. You can actually have 6 years backwards income statements and balance sheets and base your forecast on those. Then there is annual key financials, but I think more importantly, you go forward to the profitability analysis where you can see the overall profitability of the project. So when you come this far, basically you have finished the calculation, you are ready. And you can have then different scenarios. You can compare different technology, different supplier, different size of investment, different time schedules, competing investments side by side in the comparison table. So you push the calculated result to a comparison table, and then you make the second scenario and push it, and third scenario and push it. So you have them side by side in comparison table. And then you can choose the best alternative. You can continue with risk analysis. If you're a little bit uncertain about the cost of capital, so you can see with different discount rates how they impact the profitability. Or what if investment costs more than planned, or if you can save a little bit from the investment cost. Or what if price level is lower than planned, you have lower incomes, or production costs are higher, fixed costs higher. So these are ready-made graphical charts with sensitivity analysis. And you can also choose your own variables, like you can pick any lines from your calculation and make your own charts, sensitivity charts of those. Also, there's a charts function with much more functionality. You can create standard Excel charts easily, choosing any rows from the calculation, or you can make different types of sensitivity analysis like tornado charts or spider charts and so on. So when you make the risk analysis, you can continue and make the investment proposal, investment request to management. So this is a 2-page form, and it's updated with numbers from your calculation. You just press update and it brings the numbers there. And you also include more information about the project in written form in the form. So, and then if you get green light to continue with the investment, you can also continue to model financing, make a project financing for the project. This is a separate module, but it works together with the calculation so that it brings the cash flows from your calculation to the debt financing module, and there you can match then that you have the loan withdrawals matching the payments for investments during construction period, and then you can model the repayment schedule so that it fits your cash flows. And you can include as many loans as you need. So you model the debt financing there, and it takes into account the equity modeled here in the case itself. And then you press update financing here in the calculation, and it brings the interest expenses to income statement, the cash flow statement, the loan withdrawals and repayments in cash flow statement, and of course the loan balance in balance sheet. So this is totally automatic then. Then other functions, I can just give you a glimpse about it, like marginal effect. This is like a difference calculation. So basically this is used when you have some existing operations, a site or production unit, whatever, and you consider to make an additional investment to make it more efficient, to modernize, to increase capacity, or to save energy or whatever. So you make first the calculation about like status quo, like what if you don't do anything, you just continue as now, what would it look like? Then you save it with a new name and start make changes. So you add the additional investment and how you see that it will impact your operations. if it increases capacity or if it saves energy or whatever. So then you have the B calculation, which is sort of the old plus the new. So they are not. It's not as such representative for the new investment. But when you press create button here, a third complete calculation is created automatically, which is the difference between these two. And that's then the investment calculation for the additional investment. We will also practice this later today. Then we have a function called consolidation, which means adding together. So you can add different calculations, just choose them from your calculations you have saved, and they come to the list, and then you press consolidate and it creates a new calculation file with those two projects added together. And this can also be used for companies. You can create a forward-looking financial statements for group, and also you can have modeled on each company level the eliminations of company internal transactions. So and then you can, even if you have a group with many levels, so you can also form subgroups. So if, let's say you have a 3-level group, then you can make the lowest level or mid-level or all. But all can also just be selected with all. And the companies can be in different countries, they can be in different currencies, it will convert on the run. So that's also a really powerful function. Okay, let's see. Then there's impairment test verification for testing goodwill and asset values, but we will not go into that. There is a user manual available here. It will always show in the language that you are using the program. So if you switch language and you use it in Finnish or Swedish or whatever, then the manual will also be in the same language. And this change language is also powerful because you can also change language of the calculation you have created. So the manual is a PDF file of almost 300 pages. And of course you can print it, but you can also use it electronically. You can use the content and go to a specific page. Or you can use Ctrl F to find a specific function that you're thinking about. Modified IRR is the example I usually show. So it found it, and here is the formula and description for these ratios also, what they are. Okay, I will close that one and go back. And then I think we are ready. Also, I'm running the full version, the enterprise version. Now there are smaller versions, and there's slightly different. In the enterprise version, you can also make corporate acquisitions and valuations. And we will have a separate webinar later addressing that function. And you can also make impairment tests. But this is only enterprise. In other versions, you go directly to the first option. Okay, so I am ready to begin. So when I start a new calculation, I have different ways to do it. You see here is calculation file, that's the calculation. There's a comparison file, that's the comparison table. There's the financing file, that's the financing module. There's a proposal file, it's the investment proposal. So I can start here with this blank sheet to create a new file. Or if I just press any of the buttons and I don't have any calculation open, it offers to create one or open one. Or I can go from the menu, File New. So 3 ways. If I go from the menu, there is one step in between. I choose what type of file I create. I create the calculation file. And then I have this selection. I choose what type of calculation. If I choose here, it will open Invest for Excel's empty template, but I can also use my own templates and as a basis for a new calculation. I didn't have anyone specified here, but your own templates will show in this list. So I create now a new calculation file. We call it in file manufacturing 20. And it automatically stops at the calculation term dialog box. It wants to know how long calculation we're going to make and how detailed. So first of all, the term of the calculation, the ideal is that it would match the economic life length of the object. And in this particular case, we have assumed that it's 10 years. It's at least 10 years. So we make a 10-year calculation. So if I do it just on annual basis, like usually I just put 10 and okay, and that's it. But also I have the option to make more detailed. Here, top right, I choose instead of financial years, I select detailed. And now I get to choose exactly which month the project begins, which was July. Then I want to have the investment phase, the construction phase separately and in more detail. I want to see it on quarterly basis. So I switch from 1 calculation phases to 2 calculation phases. And phase 1 would be with a duration of 6 months and phase 2 a duration of 10 years. And these 6 months of, I can give headings. I just select these descriptions and I call phase 1 investment phase. And then operations. So I switch this investment phase to quarterly. So 12 is 12 months, so that's annually, yearly. But if I want quarterly, I select 3 months. So then there will be 3 months per column. And so this half year we split into 2 3-month columns. Or actually in practice it will be 3 columns because there will also be the zero period, 0 column. And there will be 10 years annual basis. I can, when I press this calculation part, I can already show how it is. So here is 0 period, then after 3 months and after 6 months. So this is the half-year construction period in 3 periods. And then there's the 10 years annually. Okay, and I will not change residual value. I will not include historical period. So I just press OK now so that we get ahead in time. Okay, I will make this slightly bigger, this screen. And we have the first main input screen, the basic values. And you see here is gray shading in input fields, so tabulator jumps to those. And if I try to enter in the wrong place, it will notify me that it's protected. So we start with the description. This is this production line. Alternative 1. And oh, by the way, here are these small gray buttons. The first one is just the periodization. I can go back and change. Then there's currency exchange, currency conversion, discount rate, tax options, and then there is, to the left, there is, on every screen is print of the screen. There is here locking possibility. There is a pointing finger, and this finger is sort of guiding you page by page in correct working order through the process. So it's good to use because then you have like always the right headings showing up. Also, you can use this button to go to the home page, start page, and you can use it as a menu to jump to selected page. And of course, you can always use the menu, but that's the easiest way to go wherever you like to go, so it jumps directly. to that specific page. Okay, now we're back here. And then there's a question mark with only short description of the page, and there is a snapshot button where you can copy that page to paste it to some other documents. Okay, let's continue. You can select if you make the calculation in ones or thousands or millions. I prefer to do it in ones, and then the currency in this case is euros. You can type it however you like. It's just text, but it will show up like that on all pages. And yeah, this currency conversion. So this is just when you make the calculation in one currency, like in euro, but then you want to convert the calculation to another currency. Let's say you want to show it in Swedish crowns, or you want to show it in dollars or whatever. So you can use this function then to convert the calculation to another currency. Or if you want, you can also convert to the same currency, but another accuracy in figures, like in thousands of euros instead of ones of euros. Then there's the discount rate. In this case, it was given, like in practice, it's usually given by management and entered by users, or it can be included in the template already so that users have it given. It can even be locked. But just to explain a little bit more about what it is, so I press this button and I go forward to the VAC button. And I think this is very important to understand when you talk about discounted cash flow methods, like this program is based on. So you calculate the cost of capital, the weighted average cost of capital. So if this is a typical project within your company, then you can use your company WACC, and then you calculate that this way. Let's say you pay an average 2% interest for your debt, but you can deduct the debt in taxation, and your corporate tax rate is 20. Let's say you have 60% debt of total capital, which leaves 40% equity, and the owners want a 20% return on equity. So now it will calculate the weighted average cost of capital to 8.96. And when I press use, it will copy it here. Then if it's a project where you want to consider that has a higher risk than normal, maybe it's another country, or maybe it's not your usual business or whatever. So then you can put a risk premium on top. So let's say you want to put 1% on top, and now we round it to 10. Usually you put more than 1%, of course. But also in the same button you have the choice to have a fixed discount rate or variable discount rate. Variable discount rate is used when the capital structure is changing remarkably during the forecasted periods. Like maybe it's a one project business and you have more debt in the beginning and you amortize in a fast pace. So then the structure changes. Then you can have a different discount rate for every period. But usually fixed discount rate is used. Usually, by the way, whatever we have as a default is the most common way to calculate. So these are like extra options. But one important feature is mid-year discounting. Now we have as default that it discounts from the end of period, end of the year. And that's like the way it's usually done, because it's a little bit more cautious to do it, not to be too optimistic. But like consulting companies, how they do it, they usually calculate from the mid of the year. And when you think about it, so it's basically it's more correct. So some cash flow is in the beginning of the year, some at the end of the year, but in the middle you're on average. So it basically gets a slightly more correct result, but also slightly higher result, usually better result. So that's why it's not pre-selected. Okay. Regarding taxation, so you have automatic tax calculation, but you can also choose to make your own tax calculation if needed. Then the formula is removed and protections removed, and you can make your own Excel tax calculation. This is sometimes needed. And there are some other options also, but I'm not looking at all options now, so we will continue. And by the way, when I immediately named the file and saved it, so it saved it with macros, so now I can just press Ctrl S to resave it every now and then. And then I continue, then the second page, my own name and contact information and phone number and some comment about what I'm calculating. I skip this time. And we go to the investment table. I make it slightly bigger. So you have rows for different investment items, and you can, if 10 is not enough, you can choose to have more items. You can also group them with headings in between. And you can name them whatever you like. It offers now this my title, but I can call them whatever I like, and then I go back to page 2 in the case. So I have machines, I have investment in building, and I have a maintenance investment. And you see periods, there's the 0 period, and there is the 2 other quarters of the construction period investment phase, and then there's annual for 10 years. And then at the end, I press this button here to jump to the end. Oh, what's happening? Okay, it jumps. Okay, it's there. Yeah, I didn't see it. So here is the residual period. So at the end, there is a separate column for residual values. They will be combined in the cash flow. So they will happen at this exact same moment, but they will be specified here separately. Okay, so let's put, so we strive to make the investments according to payment schedule, because it really matters when the investment happens in the beginning, has a major impact on profitability. So now it was 1.5 million invested in machine and equipment. So, and it was split equally. So it's -5. Okay, it should be a minus, but if I forget to put the minus, it will react and offer to change the minus. And then I can just drag it to the 2 other periods like that. And then the building, -100,000, -200, oops, -200,000, and -200,000. So total 500,000 for the building. And then we have a maintenance investment in 27 year of 300,000. So those were the investments. And then I will put the depreciations. If I don't put depreciations, then there is the full residual, the full book value as residual value automatically in Invest for Excel. Okay, this is a setting that you can adjust to your liking if it is or not. I mean, it's available. It's pre-selected, automatically calculated realization value at the end of the calculation term, but I can also deselect it and then it will not do it. But it may do it in this case. And okay, so notice depreciations are selected row by row. But in case you have like many items and they all have the same depreciation, like very often is, then you can here at the top select to apply the same depreciation to all selected rows at once. So you don't need to go row by row and do it. You can do it also once for all. So let's see. Depreciation of the machines is in 10 years. It offered 10.5 because it was 10.5 years was the term of the calculation. I want to make a straight line depreciation for machine and equipment, but I will begin the depreciation when the investment phase is over, and I will start operation. in December 21, but including 12 months. So it actually from beginning of January 21. Okay, like that. And then for the building, we probably have a longer, we have a 20 years depreciation, 20 years straight line. And here I choose a balance sheet item, buildings and structures. This is not an important thing. I mean, it will not impact your calculation if you forget to do it. It's just on which row in balance sheet it shows up. And same thing, we start depreciating when the construction is ready. Like that. And we press OK. And then we have the maintenance investment, which happens in 27, and we have only 3 years left. So usually it's then depreciated on the years left. So in this case, in 3 years. So I put 3 years depreciation time. It's machine equipment. I start depreciating. Let's say I start from beginning of 28. Yeah, then it's exactly 3 years. So now the value, there is no residual value for the machine and equipment, but there is for the building, because the building still has some value after 10 years. I can, of course, adjust the value. Maybe it's lower, maybe it's higher. I just change the number. And by the way, here on top, there is this level of detail. So you can have 5 different levels of detail. This is on every page. So now when it's by default on level 3, it means that it does not show all the information that is on this page. Some is hidden. So I switch from 3 to 4, and it shows the book value of the items. And you see how the book value of the building is decreasing, but it's still worth 250,000. So that's by default the realization value here at the end. Okay, I'm ready with the investments. I will save again. I like to do it, it's safer. I mean, even if it would crash, Excel would save it, but I still prefer to do it every now and then. I recommend to do it. So then we continue to the next page with the finger to right. And we come to the income statement. And it's empty. There are some headings, suggested headings, but I can rename them. So I start, here is income rows, 10 main rows, and then there's for variable costs, fixed costs, and so on, the whole income statement. So I begin with to model the income, the sale of the increased capacity. Sales of product X. And it's quite simple. Okay, so I manage with 3 rows. Yeah, let's do it like that. There are different options how I could do it, but all the same in Invest for Excel, there are thousands of different ways to do it, but so it's up to yourself how you prefer to do it. In this case, I will model the capacity of the production line. Which I will multiply. So for each row, there are operators to the left. I will multiply with utilization rate. This will be a percentage. And then I will multiply with price per ton. metric ton in euros. Okay, so the capacity is like 2,500 tons per quarter, 10,000 annual basis. So I enter the 2,500 here in the first column, and invest for Excel is usually it's enough to just enter one number and then use the copy distribute button to distribute it to other periods. So getting to know this button and using it actually really makes life simpler. So I press the button, I select to adjust with number of months per interval so that it always goes and reads how many months there is per column and adjust for that. Then I can have some change. In this case, I don't want change. So that's it. Third click and it goes off. And then utilization rate, okay, we don't produce anything during investment phase, but we start here. But we start with only half capacity the first year. So I put 50% utilization rate. And now, because it rounds to full numbers, I format it to percentage. And I can distribute it so it copies the formula. The format I mean to percentage, so then I can just slightly adjust. I can also enter hard code values like we just know by experience or expect that it will be 65% second year. And from that point forward, it only grows slightly per year. Let's say it grows with 2% annually. And this, when I make a change percent, I can also select to show what percentage was used. It will put it in the D column to the left. And it will also be a dynamic value so that if you change it, it will impact the numbers. And then I just press distribute. Okay, so we see it grows to some 76%. And then we put the price per ton, which was given as 200 euros. This is some chemical substance sold in tons at the price of 200 euros per ton. And this is the price in 21, and we are optimistic that it will increase with the 2% inflation per year. So I just press one click and choose 2% growth and make it visible to the left and press distribute. So when they show up here at the left, so then they are also dynamic. Means if I change the number, like utilization rate would go 3%, then the numbers will change. So it's dynamic. And yeah, I guess that's it. So we have modeled the income, and so 10,000 multiplied with 50% multiplied with 200 gives 1 million. So that's this is from the one income category. We can have 10 different income categories. And then they are all summed up on the income row. So now we have the income modeled. Then we go into the production costs. So we have we have to split the variable costs and fixed costs. And this is just mainly so that when you model that you really consider if it's a variable cost, then it changes with the volume. If it doesn't change with the volume, then you put it as fixed cost. You don't have to think about how it is in official accounting income statements. This is just for your own modeling to help you. So we have raw materials and consumables. We have energy costs. We have in this case we put stuff as fixed, so we don't we have the same amount of stuff, although if we have a lower production amount. So we don't need it even, but we have freight costs, which are variable. The fixed costs are then, I can put them at the same time. They are staff, personnel costs, we have maintenance costs, and other fixed costs. But let's start with raw materials and consumables. So we have a cost per ton. So it should be like the production multiplied with cost per ton. So again, 2 rows, I guess, is enough, I assume. So we have the cost per ton, and we have multiplied with production metric tons. Yep. So the cost per ton is 50 euros. And costs are always with minus. So minus 50. And we expect also this row to develop with a 2% increase per year. Like that. Then the production amount. Okay, I didn't model it so that it's visible here. I could have done it. Would have been nicer. But now you can also use Excel formulas. This is Excel. So just enter equal, and we multiply the capacity multiplied with the utilization rate and press enter. And now we have the amount produced, 5,000 tons. 5,000 tons multiplied with 50 euros per ton gives a cost of 250,000. And now in this cell is a formula. So notice now when I distribute this cell, Invest for Excel automatically recognizes that there is a formula in the cell and offers to copy the formula, not the value like it has done so far. So that's nice. That's how we wanted it to do. Then we can do the energy costs in a similar way. We can have 2 rows again. Energy costs per ton. And let's do it another way this time, just to show you. There are different ways to do it. We put energy costs here. And I now remove the operator from the first row and don't leave it on one row. So you can also use, so if you have many rows, so you can have your own formula on one row and have a plus there, and then the other rows without operators so that they are not calculated automatically. So now I put the cost for energy is 10 euros per ton minus 10. I distribute it with 3%. We expect the energy cost to increase more. So in Invest for Excel, you don't have one central inflation. You have to take stand item by item because different items develop in different pace. So now we think energy will increase more. It's a low cost. Now it will be higher in the future. So we calculate the 3% increase like that. And now instead of how many tons produced, I put a formula here, which is equals 5,000 tons multiplied with minus 10, so minus 50,000. So it's just another way to calculate the same thing. And now again, it recognizes there's a formula and it copies the formula. And then I will do the third one fast. This is a little bit repetition. freight. And now I do it the first way. Yeah. The freight cost is 30 euros per ton, and it will develop 2.5% increase annually. And then I will take the metric tons and copy the form. That's it. Now I had the variable production and freight costs modeled. I save and I continue to fixed costs. So for personnel, it will begin already from 1st of October. They will be hired 3 months prior to the start of operations. So the cost is 100,000 per year, but this is a quarter, so it's minus 25,000. So again, it's enough to enter one value and press copy distribute, adjust the number of months because salaries are depending on time. So like that, and then we have some development for salaries, 2.5%. Make it visible. And I haven't mentioned this applied change. So by default, it's per year. So I get the raise once per year, not every month or every quarter. That's the difference. If I choose per period, so or the next period it's higher. Of course, this change given is annual, but it will split it to monthly or quarterly. So we keep per year. Maintenance costs start 21 from the beginning. Could we start 22 actually? But it's here minus 50,000, and it will develop with 2% increase. And then we have other fixed costs also starting here, minus 25,000. No, actually it's 12,500, 50,000 annual basis. And I distribute it the same way. Adjust with number of months, annual change 1.5%, put it visible and distribute. Okay, now we are ready with our case. Basically, it's then just working capital. So once you get used to this copy distribute, so it really simplifies modeling. I save it, and actually I want to get rid of these empty rows when I didn't need them. So top left, just under income statement heading, I can choose which rows to hide. And I choose select empty rows, then it hides the rows that I didn't use automatically. By the way, now when we are here, there's another tab where you can rename rows. So also anywhere in the program on all screens, you don't have to settle with the names we have given for rows and items. You can rename them according to the terminology that you're used to use in your company or your industry. So you can rename. And as you see now, when I made my own rows, I could, if I make a template, I could also make those rows in the many languages, so the program can even translate then the own rows. Okay, now it has hidden the rows I didn't need, and it's more compact. And you remember the flip buttons. You can also choose to hide some of the specifications. So it's easy to open and close. But you can also use this numbered. So if you want to go one level deeper, you just go to one number bigger. Or if you want to look at really short overview of income statement, you can do it. So anything in between. Okay, so let's see. We have a good, healthy income statement, we have big gross margin, good EBITDA, operating income before depreciation, there are depreciations, and we have the EBIT, operating income, some 400,000, and we make profits, so we pay taxes, and the profit is also looking good. But still, we don't know if it's a feasible investment or not, if it's profitable. Okay, I will continue to next page, which is working capital. And we have some assumptions for working capital as well. So we have, it's divided in short-term assets, inventories, and current liabilities. So in short-term assets, we have accounts receivable and other receivables. Inventories is inventories, but in current liabilities, we have accounts payable and other current liabilities. But in this case, it's simple. We have accounts receivable. We wait 40 days on average to get paid for the delivered tons of our product X. So I put 40 days on the row for average term of payment. And 2 clicks, 1, 2, and it's distributed to all periods. And then it calculates automatically 40 days of sales as it sort of moves to next period always. So it's missing from this year's cash flow, shows up in next year. So it pushes forward, and the last account receivable is in the residual. We assume the customers pay it. Then inventory. So, okay, this is a little bit more complex in this case. I mean, if I just have for the cost of goods sold, then I just enter this, but I can also specify. So in this case, I want to specify for go to the button here left for inventories, the gray button with 3 dots of inventories. And here it shows from which row it calculates. So take the raw materials, that's okay. In this case, I want to have the value of the end product. So I want to have all costs related to production. So raw materials, but I also want to include energy. And I even want to have production personnel costs. And they are here, stuff. So now I select those 3 to be included. Remember, the only default was raw materials and consumables, but now I want to include them all. I press OK. And the turnover period for turnover time for my inventory is 20 days. So enter 20 and the 2 clicks again. And then we have the value of our inventory automatically calculated. Okay. But on the other hand, we also have some term of payment to our suppliers of raw materials and also for energy. And that was 30 days. But we also have other costs take into account. We have maintenance costs and we have other fixed costs. So in this case, we need to use this gray button to have 2 different groups of suppliers. You know, in this case, we only had 1 inventory, and so we just specified what is included in that. You could have 5 different inventories, but we didn't need. But in this case, we need to have 2 different terms of pay for different suppliers. So I choose to specify 2 groups of suppliers. The first one is raw materials and energy. The second one is maintenance and other fixed costs. For raw materials, it's 30 days, and for maintenance, it's 20 days. But first I need to specify which rows. So raw materials, energy, okay, they were automatically pre-selected. It's like the best guess, and it was correct. So I can distribute the 30 days. 2 clicks like that, and then we have the value of the raw material and energy inventory. And then we have, no, not inventory, sorry, the accounts payable. Then we have the maintenance other fixed cost for 20 days, so I need to select. It now offers again the same rows, which is wrong in this case. I want maintenance and other fixed costs, like that. That's what I base it on, and then I distribute the 20 days like this. And okay, and we have the accounts payable for that group. So we have the accounts payable change here, yeah. And then the working capital total change here. This change is important because this that goes directly to cash flow. So we need 100,000 more here in 21. So it impacts cash flow and profitability, and should not be omitted in calculations, the working capital, as it very often is. The total working capital we see here. So the account receivable increased need for working capital, the inventory increased need of working capital, the accounts payable decreased the need of working capital. So this is the net working capital needed. Okay, we are ready with working capital and we are ready with the calculation. Now let's look at the reports. We have income, variable production costs, fixed costs, taxes paid, change in working capital. Together they make cash flow from operations. And then we add the investments. And then we have the free cash flow. So each free cash flow is also discounted to the beginning. We can move the calculation, but by default is beginning. So 417,549 end of 22 is 329,000 in the beginning of July 2020. The discounted value. And these discounted values are added together here in this cumulative discounted free cash flow. This shows the position we are in at the moment. So we are still 1.5 million negative, but it develops slowly in the right direction. And I can already now see that in 28 it has paid itself back, and we start generating added value, positive net present value, and the net present value will be 774,118. This looks very good. And then the total cash flow undiscounted and cumulative total cash flow undiscounted. This is our bank account is a little bit on the minus here, some plus 2 million. And so this is because this is need for financing. I can cover it with equity and debt. Remember, I can use the financing module and just press exclamation mark to import it here. But the good thing with the net present value method is that I don't have to consider about financing yet. I'm just at this phase, I'm just checking if it's profitable or not, if it's feasible. If it's profitable, then I can model financing. Because I already added the cost of financing in the discount rate. So if it's a positive net present value, then it's doable. No problem. Okay, cash flow statement. Next page is balance sheet. It's just a report, actually. I can open to see here are the machinery and equipment, here is the buildings and structures and so on. And here is the inventories. We have the account receivables from customers. And the bank and cash looks a little bit bad here in the beginning, but really good at the end. And we have losses and profits every year from this project is accumulated here at the equity of the company. And we have the accounts payable suppliers also. Let's go then directly to the result page and see about the profitability of the investment. Yeah. So summary is that the total investments were 2.3 million. The discounted value of them was 2.1 million. The required rate of return discount rate was 10%. Calculation term 10.5 years starting July 2020. So we have the present value of the operating cash flows, and then we have the present value of the residual value. And remember, the residual value included the building, but it also includes the working capital and cash flows. So this net 160,000 is the present value of the building at the end, which was 250,000, plus the working capital, the received accounts payable, the used inventory, and the paid suppliers. So these are summed together and discounted to the beginning, so it gives 160,000. So the total present value of business cash flows is 2.8 million. And then the reinvestments. And now I noticed that I forgot to mark the reinvestment, the maintenance investment year 7 as reinvestment. So I will go back and do it now. Doesn't matter. I go to the investment table. I choose the third row, maintenance investment. I press the depreciation button. And here in the depreciation button, not all functions are visible by default, but when I press here, top right, I get more options visible. I press the more options, and I have down here to the left a tab called investment category showing up. This includes, I can mark a row for investment or subvention grant. Grants can also be included. And I can mark it as a proposed investment or a reinvestment. So this is important because we want to separate the main investments in the beginning from the maintenance investment, reinvestments later. So now when I press OK, it turned white. The main investments are blue rows, and then this one is white row. So now when I go back to the result sheet, the investment moves from proposed investments to reinvestments. And it's included in the present value. Why does this matter? Yes, because when I make the investment proposal, the investment request to management, I now request 2 million, not 2.3 million, to be spent this year. This is a investment which will follow because of this investment, but I mean this is 7 years later, so we don't ask for that money now. So that's why you can separate. So it shows up here. It's part of the business that you need to keep it running. And then this is the total present value, and then you deduct the present value of investments, and then you arrive at the net present value, 774,118 euros. So this is the added value after the owners got their 20% and the bank got their 2%. So the owners have got their return and the bank got the return, and then still it gets an added value of 74,000. So monthly annuity is 9,761. So this is this net present value per month. You can also look at it per year in this new version. In the previous yearly annuity, this is a new feature. So per year, it's about 122,410. And then we have the internal rate of return, IRR, sort of return on investment annually. So it's 16.7%. It's also higher than required return, quite nice number. And the modified IRR is 13.5%. And again, to explain what's the difference between these two is that the IRR assumes that the profits from this investment that will be mounting up on the bank account are assumed to be reinvested again, giving the same return, 16.71%. So money is never idle, it's always reinvested immediately, giving the same return. The modified is a little bit more cautious. It assumes that when it's reinvested, it will give us a 10% return, which is our cost of capital. So that's why it gives always a value which is closer to discount rate. But as a decision rule, it doesn't matter which one you use because they will both give the same go or no-go decision. I mean, if IRR is above discount rate, then also modified IRR is above discount rate. If modified IRR is below discount rate, then also IRR is below discount rate. So they will always give the same decision. And then we have the profitability index, PI. So this is a good indicator in that sense that it's relative. So it tells us that we get in present value, we get our money 1.4 times back. The present value is 40% bigger than the present value of investments. So 1.4 is the index. The discounted payback time is 8 years. So this is taking the cost of capital of 10% into account. Without that, it would be much shorter. It's available here. It's hidden because we don't recommend to use it because it doesn't take the cost of capital into account. It would be only 5.4 years. Then there are some other ratios, return on net asset value, average value added per year, and all value added per year summed up and discounted, similar as net present value, but based on income statement and balance sheet. And you can even calculate IRR, modified IRR, based on economic value added and payback time on value added. But if you don't consider those important, like I don't do, then you would hide them in your template. It's no need to show things that are only difficult to describe. So you select which indicators to use and which not, and then hide the rest ones. And this will also impact when you push your result to the comparison table. The comparison table will automatically hide those that you don't use. So you have access to it here on top of. So I mean, this is now scenario 1. This is alternative number 1. Then I can have push that to column 1. Then I can have the scenario 2 here and scenario 3 there. So I press put on 1, and it says there is no open comparison file offers to open, but actually we want to create a new one. Create a new one. And it offers to save it with the name InComp, investment comparison. Well, okay, let's give that name. And you see, it took a snapshot of the calculated, profitability of this case here in the first column. So that's nice. Now we have it already. I can, by the way, save it already. And then I just go back to my calculation. And by the way, if you wonder why this monthly annuity or yearly annuity, especially this monthly annuity, I might hide the other one. It's very, very handy. When do you need it? When you think about when you consider that you replace an old machine with a new one, and this is a typical situation. You make a reinvestment, a maintenance investment, and you have the options to continue use the old equipment or to replace it with the new. And the tricky question is the timing of the reinvestment. So if you have the option, you can still continue use the old machinery equipment. You maintain it. It's not as efficient. There's a higher cost of maintaining it. So that's one option. And the other option is to invest in a new machinery equipment. And so they have the new equipment has a longer usage term. So let's say you can use the new one for 10 years. And the old one you can continue for use for 2 or 3 years. Let's say 3 years more. So you make two calculations. But for the old machinery, when you don't have a negative cash flow in the beginning, so you cannot calculate IRR, you cannot calculate payback. So you only calculate net present value. For the new investment, you can calculate IRR and payback because there is a negative cash flow in the beginning. But it doesn't help because you can't compare those with the current old equipment. So you can only rely on net present value, and the net present value of 3 years is not comparable with net present value of 10 years. So you can only rely on net present value as a monthly annuity or annual annuity. So if the monthly annuity of the old machine is higher than for the new machine, then continue maintaining the old machine for as long as it's feasible. Or if the monthly annuity of the new machine is higher, then switch to the new machine as soon as possible. So it's very simple, and it's the only indicator you really can use. Okay. Then let's look at some sensitivity analysis for this case. Let's start with break-even analysis, which is maybe my favorite one. So if I go, let's say I go to income statement, and we're really a little bit uncertain about what the market price of this product will be. We have assumed 200 euros with a 2% increase, but what if it's actually lower? How low can it be? How low can it go before the return is lower than our capital cost? And when do we start making loss? So I select this 200 euros. I can press this button with the red arrow down to plus minus 0, or I can go from the menu analysis, sell break even, and it asks me seek break even by changing active sell value. Break even is when net present value is 0. I press OK, and it will start doing it. And actually, it didn't take even a second, and now it tells me that it should be at least 177. Not lower than that, even taking into account the 2% increase. At 177 euros market price, we are net present value 0, return 10%, and profitability index 1. So you see the owners get their 20% return and bank their 2% interest, but nothing more. So that's the minimum. And if you wonder why doesn't it pay itself back, it's because the payback formula does not take residual value into account. That's the official formula. If it didn't pay itself back during the product main operations phase, then it didn't pay itself back. It does not include residual. But we know that it's a break even now. And then I can just simply take analysis under break-even from the menu, and we are back at the starting value 200. And we can do it for any other input value. We can look at what about the raw material cost? What if we are very much depending on that also? What if that gets higher? I can press the button for break-even, and it tells me that it can go up to 73 euros almost for break-even. So there is a margin. And then I just undo again. Okay, like that, that's break-even analysis. Then there are the other sensitivity analysis. There is for discount factor. Now we included 10% cost of capital, but if a little bit uncertain what to use, so we can have different. It shows with 11, 12, 9, and 8%. So how it will impact net present value. Okay, next one is investment amount. What if it will cost more than planned, 10% more, 20% more? How will it impact net present value? Or how if you can save 10% in the construction costs? And of course, now it offers net present value, but you can choose any indicator of selection. So I can look at IRR or payback. So even if it costs 20% more to build this production line, it still gives 13% return. Quite nice. Then next one is the sales. What if the price level is 10% lower, 20% lower? Ooh, 20% lower is bad. Then it goes to 4% return. Well, okay, it's not that bad. The bank interest cost was 2%, so it still covers that. Just the owners have to get a little bit of their own profits. And 20% higher price level gives a really high return. And here below is annual ratios, and now it shows first year, which is no product. So there is only investment, so I can just choose another year with operations like that, and now we have the indicators here. So in the middle is the case at hand in the calculation. And then there's worst case and better case. So impact on EBITDA or EBIT with lower pricing on RONA-EVA. And actually, I can include many more indicators here. There is something called input key financials, which is empty by default. You can add your own ratios, you can name them and create your own formulas, but there is also in the new version a set of standard ratios where which you can choose which to include or to include all. Liquidity ratios, turnover ratios, profitability ratios, business ratios, financial risk ratios, stability ratios. And some of these sort of require the full picture to work as planned, sort of include financing. And so they are more used for company analysis, for business planning, for business valuation. But in some cases, they can also be useful in projects. And now you see when I added, they are all listed here. So you can add your own also. So you can choose whatever you want to. Return on assets. So now it's included here. Where did I select it? There. So return on assets as planned is 52% on the year 2023. If I get a this is interesting. It goes like the other way around. Yeah, it has less assets, but lower price. Okay, and well, you can choose any of these. The next analysis is the variable costs. What if they are 10% higher, 20% higher? How does it impact IRR or payback or whatever? Then following one is fixed costs, how they impact. Then there is chosen variable. So now I can choose any item. If I just want to see at freight costs, I can choose even freight cost per ton. So and then choose example variable from 2021. Yep, 30 euros was assumption. What if it's 10% higher, 20% higher, or what if it's 30% higher? I can also enter any value here and press exclamation mark to update. Then return with 14%, but okay, it's no panic. And there are many of these, so I can choose include many of the individual indicators from my own calculation. Whatever I named is available here to be chosen. So quite nice. Okay, forward, when I go forward with the sensitivity analysis, we have charts function to create standard charts, and we have analysis chart like spider chart and tornado chart. Let's do the tornado chart. And I can include whatever variables from my calculation. I have investment in machines, in buildings, maintenance investment, all investments, utilization rate, price per megaton, raw material cost, energy cost, freight cost, staff cost, and call it tornado, plus minus 10, plus minus 10. So now what happens is that it changed each variable like plus minus 10% and looked at the impact on net present value. And then it sorts for me in order of impact. Okay, these three will have the same impact, so I can reduce those. And let's take cost per ton and update like this. Now it looks like I wanted to. So we have, of course, the sales volume or the sales impacts highest. So if you have 10% more sales, net present value will increase with 669,748. That's like the price impact. Then the production volume has a lower impact because then the production cost will also be lower. Then we have the raw materials cost per ton. We have the cost for investment in building, energy costs, maintenance investments, and maintenance costs and maintenance investment. So it's really sorts by order of importance the variables. So this is also really handy. Furthermore, I can also use this function to create standard charts. I can choose from which page to create, which rows to include. Give a heading, choose which periods to include. So now, in just a matter of seconds, I can choose to make the type of charts that I want, and I can adjust them with Excel functions. Like this was the cash flows. Cash flow per period as a bar and cumulative as a line. And this is without capital cost, and this is including the cost of capital. payback without and payback with cost of capital. And furthermore, let's see, there are also ready charts. I created charts, but you can just choose from a list of already made charts and analysis charts. So let's look at something like equity and liabilities, how they develop over time. So whatever charts you create, they come as extra sheets in your model. Then we still have, we have the DuPont analysis, which explains like the structure on how the return on assets is calculated from income statement and balance sheet. Really good overview, really educative. You can also look at return on equity. We didn't have any depth in this model yet, so it's not really representative, but it's available. And then we have the Monte Carlo analysis still. So just to show you, let's make a really quick version of Monte Carlo analysis. Let's take on the price. You can, it's like a random generator of numbers within some certain values, taking some standard deviation into account. So I choose the variable price of end product, and I think that in very, very worst case of a pandemic, it would go down to 100. And in really, really extremely good times and some scarce resources, that we can get 300 euros per ton. But on average, the price fluctuation per year is like, no, it can be quite high actually. Let's say it's 10%, 20. And I can add as many variables as like, let's make two. I will take the raw material cost as a second one here. And I think let's make the same. Minus 75 is minimum, maximum is minus 25. Standard deviation is, let's make it higher, 7. And I choose for net present value, and then I can choose how many thousand calculations I will make. I will only make 1,000 now to make it faster. We are a little bit behind schedule, or actually not, we're right on schedule. So now it makes 1,000 calculations for me, changing both those variables, making random numbers with the minimum, maximum, and taking the standard deviation into account, and creates this report to us with the probability distribution of net present value. So now the beauty of this analysis is that we don't have just one calculated net present value of 774,000. We have a probability distribution of different possible net present values. The expected mean 721,000, the median 711,000. The probability of negative net present value is 14.1%. This is valuable information for me. So this is the risk of making loss in this project, 14.1%. And these probability indicators, it comes directly from statistical theory. So it's 1 times standard deviation, 2 times standard deviation, 3 times standard deviation. So with 68% probability, I know that it's between these values. And actually, if I read it right, so it's like with 86%, 85.9% probability, it's a positive, and it's minimum 0 net present value. Yeah, positive. And you can also see what, when it makes those 1,000 calculations, what different results it's got and how many times, the frequency of different results. So this is nice. Okay, I think we have spent enough time on case number 1. I will just simply save it. And what we will do next is that we will now look at alternative number 2, automated production line. So I will go to input basic values. I will begin to save the new name before I even start changing numbers. So save as like in Excel normally. So this is automated production, manufacturing, and it's automated production line, alternative 2. Otherwise, these basic settings are the same. No changes there. Then I go to the investment table and we look at what does it say in the case. It says that the automation would cost 400,000 in addition to this investment, and it would happen in December 2021. So now I could make it a separate row, of course, but I'm lazy. I use the same row for machines and increase these machines with 400,000 to 900,000 in the end of December. And that's it. What are the other changes in this calculation? Let's go forward. What we gain by making the automation? Yes, the gain is that we save half of personnel costs overall. Okay, personnel costs, staff costs are here on this row. And remember, we entered one value and distributed, so I can just change the first value again. Basically, I can divide it with 2. Now it's 12,500 and automatically adjusting like before. And that was the only other change in my calculations. Now I'm ready, I can save. Now this is the automated production line. I look at the result page. It's also profitable. I don't remember, is it more or less profitable? Let's push it to column number 2 in comparison table and look at them side by side. Ooh, quite close. Slightly lower net present value for automated production line, slower IRR than modified, lower IRR than modified IRR, and longer payback time. So the automation does not pay itself back according to this. So now we use the comparison table, and then we can also like show graphically to management that why it's clearly more profitable without automation and hire more staff in this case instead. We can also remember I mentioned this marginal effect. So let's assume now to demonstrate this function that we have the production line and we're considering to automate it. So we have the alternative 1 calculation, which is the new production line. We have already made it. We made the addition at least, and now we consider to automatize it. Is that a profitable investment as such or not? So we have the V calculation, which is like the production line with automation. And we want to see, is the automation in itself a profitable investment, marginal investment? So we will compare these two calculations, and Invest for X will automatically create a third calculation, which is the automatization of an existing production line. So I choose situation before investment. I don't have it open, so I have to select the button with 3 dots and select it from saved location. And including new investment, the automated production line I have open, so I can select it from the drop-down and press create. So now when I press create, it will start comparing those two calculation files and creates a third new file with the difference. So only the differences will show up. Now it was ready. This is automatization of existing production. Let's make it here. So let's look at this file. Look at the investment table. Oh, that was quite empty. So now you see only the additional investment shows up and the depreciations of that one. Everything else is same in both cases. No sales, well, there is no increased sales because of automation. The sale is same, it's just a saving in production costs. Not in raw materials or energy, not in freight, but in staff. And here's the saving. A positive cost item is a cost saving. So this is how much we will save because of the automation. And it gives up, even after depreciation, it shows profitable income statement, so it looks good. We look at the change in working capital, we look at the cash flow statement of automation, balance sheet of automation, and the result. And okay, now we see, okay, yeah, it gives a 6% return. So it is, in a sense, it's profitable, the automation, but our management has set a minimum required rate of return of 10%. So it does not cover the cost of capital. So net present value is negative. So we should not pursue this automation. And by the way, if I now press this one in column 3, just to show you one thing. So this net present value is minus 56,823. It's exactly the difference between these two. The net present value of production line without automation is 56,000 higher than the net present value of automated production line. Okay, so this was sort of a parenthesis. I will close this automation case. And we still have one case left, which is the outsourcing of production. What if we don't produce ourselves? We have the customer relationship, but we don't necessarily have to produce the item ourselves. We can also outsource the production. So let's go and make case number 3. Make sure this one is saved. And now we save it again with the third name, save as outsourced manufacturing. That's alternative 3, outsourcing. Okay, so again, we can assume the same basic assumption, same periods, etc. Then we go to the investment table again. And my case says like this. There is no investment for machines. But we had the same investment for buildings, so we assume, but this is just assumption, it's stock or something, inventory. But we don't have the maintenance investment for machinery either. We just have the building. That's unchanged. But we save 1.5 million on machine and plus this maintenance investment. And we don't have that major investment either. Okay. Save again, and then I go forward to the income statement. And I guess, again, the income is exactly the same. It doesn't change the sale. We assume that we get the same quality and same deliverability. Actually, this is not then raw materials, it's the cost for the product. I just rename it to COGS, cost of goods sold. And this is like sales. And of course, this will be higher. But in this particular case, the idea is not to enter it, but to make a goal seek at what price it is equal to producing ourselves. At what price is just as profitable as producing ourselves. So if we can then buy it at a lower cost, then it's a better option. So let's say we have no energy costs. Freight is the same. Freight is the same. How was it with the personnel in this case? Let's see. Just a moment. Okay. Yeah, personnel is 50,000 per year. So that's basically what we have. No change, no maintenance costs. Other fixed costs are 50,000 also. So that's basically also what we have already. So that's good. So we are good to go. I guess we have. Yeah. I'm ready. Let's look at the result now. Now it should be really profitable. And it is, but this is not reality yet. So now we want to use goal seek to find at what price we can buy the outsourced product to get the same return on same IRR as on our base case. So let's go to the current base case. We have IRR of 16.71. I'll be right that up, 16.71%. So now we'll go back to my outsourced calculation and I will make a goal seek. So I switch to Excel menus. I take data, what if analysis, goal seek, set cell IRR to value 16.71% by changing cell price per ton for purchased product. And I press OK. And it searched for me and now it found. Okay, now we have the same IRR. In outsourcing case, I will save it. And now I will look at the income statement. So 133 euros for ready-made product per ton equals if we make it ourselves. So if we can buy it externally at the lower costs, then it's a better alternative producing ourselves. If I push this one now to, I put in the fourth. So then we have the same IRR. This is interesting. Yeah, we have the same IRR, slightly higher modified IRR, but longer payback time and much lower net present value. So okay, now we come to really philosophical questions. So you see, even if the return is the same, it's sort of still better to produce it in-house because you get a higher net present value, you get a more value added within your own organization. So alternative number one is better. I mean, okay, now we have equal IRR. Okay, we can, of course, if we can buy much lower, then maybe this gets higher. If we can buy at that much lower price, so let's make still that scenario. This is because this is an interesting question. So I will go to back to invest menu and input. Let's still change. I save this one. No, let's keep the same. What if we can, let's say we can buy it at 100 euros. That's fifth choice. Then it's clear. See, then outsourcing is the best choice. Not just we get the highest return on, because we invest a little bit less, much less than in this case, so we have a relatively better return, but we also have a higher net present value. Okay. So I think you were quite good to be following for such a long time my long presentation with a lot of numbers and details. So I thank you for that. And if you have any questions, you can type them. I will answer the questions right here. And so you can just type in the Q&A box any question, and I will reply. But also, yeah, I promised I will send you the presentation. I will send you the calculation files. I will also tomorrow send you a link to this video if you want to repeat, if you don't have anything better to do. So you can look at it again. And otherwise, I thank you very much for attending and staying this long through the whole 2-hour presentation. And of course, you're also free to return by email or phone or chat to me or us anytime. So thank you very much, and have a nice rest of the day. Thank you. Bye-bye.